Good morning, Trinidad and Tobago, and a very happy new year to you. So we're getting started with the Bourse report for 2024, and today we're going to take a look at the performance of equity markets over the course of 2023, how they would have fared. Certainly mixed results depending on whether you have an international or local bias. Let's take a look at the performance of those varying equity markets and what investors might begin to expect in 2024 as we tread into that new year. Well, turning firstly to those regional indices and the regional equity markets, well, it was yet another year of not so good reading in terms of equity performance, with that All Trinidad and Tobago index down 9.8%, following another less than stellar year in 2022, of course. The Trinidad and Tobago Composite, which measures both those local stocks as represented by the OLTNT and that cross-listed index, which we're seeing in green. That Trinidad and Tobago Composite Index in that yellowish color was down 8.9%. Again, with both the locally domiciled stocks, the OLTNT stocks, as well as the cross-listed stocks down, the CLX down, or the cross-listed exchange down, or index rather, down just about 5.6% for 2023. The Trinidad and Tobago Stock Exchange's Caribbean index was down also 6.1%, which represents a much broader reflection of regional performance. So certainly no better faring at the regional level in terms of equity market performance as measured by that Caribbean exchange. Now, when we take a look at some of the major movers on the Trinidad and Tobago Composite Index for 2023, well, there was some fairly disparate or divergent performance. And looking at the top performers, for example, we see that Prestige Holdings would have advanced just about 48%, a whopping 48%, on the heels of revenue and profitability recovery. Agostini as well, with continued acquisitions as well as improved earnings, would have advanced just about 37%. National Flour Mills rebounding up 29%. First Caribbean International in a higher U.S. interest rate environment, posting significantly higher earnings as well as revenues, and that stock would have advanced just around 29% as well. And National Enterprises Limited up 22%, much of that due to a late flurry towards the end of 2023, as dividends or a very robust dividend declaration would have gotten investors very excited over NEL's stock price. On the other end of the scale, of course, there was some fairly pronounced underperformance over the course of 2023, and BFG, with all of its leadership changes as well as earnings challenges, would have declined 25%. GMMB Group Limited down just around 29% as well on some muted earnings. Guardian Holdings as well down just about 30%, again driven to a large degree by some uncertainty in terms of earnings performance over the last year. And of course, investors will be looking based on those recent accounting changes or accounting standard changes to see how Guardian performs on a continuous or more continuous basis. NGL, the absence of a dividend, of course, and some uncertainty as to when a dividend, in fact, would be paid by NGL, led to a 52% or decline, and Whitco, with its revenue and profitability challenges, down just around 57%. So certainly, when we take a look at that local/regional performance, not some very good performances, some not so good performances. Turning very quickly to the international side of things, well, the U.S. markets, after a very uninspiring 2022, posted a fairly robust and encouraging 2023 result, with a 24% increase in market valuations as measured by the S&P 500. Some of those best performing stocks would have included the technology sector up 54.7%, communication services up 51.4%, and consumer discretionary, which was rather surprising in an environment that was characterized by high inflation and the erosion of disposable income. Consumer discretionary stocks were up just about 38.4%. On the other end of the spectrum, consumer staples down 3.4%, the energy sector down 4.1%, and utilities somewhat expected in a down 10.2% in a higher interest rate environment. At the broader international level, we also saw generally robust performance, with European equities, for example, advancing 15.6% after a 10% decline in 2022. Asia ex-Japan also advancing or eking out gains of 4.6%, despite China's equity markets, the largest Asian regional equity market, down 13 odd percent. Asia, ex-Japan, broadly was up 4.6% after 2022, in which it was down 19.7%. And Latin America producing fairly robust returns after treading water in 2022, down just 0.1%, up 25 odd percent in 2023. So certainly, as an international investor with broad regional market exposure, would have been a very good or vintage year. Now, for 2024, there are a couple spillovers in terms of market drivers that will cross over from 2023 into 2024. At the local level or the local/regional level, that cooling inflation is going to certainly be supportive or more supportive of investor sentiment as we head into the new year. Resilient and, in fact, improving earnings will also be a factor, certainly. When we take a look at some of the bellwether stocks and their performances in 2023, it certainly was an improvement over 2022 and gives a lot of optimism or should give a lot of optimism for investors as we move into 2024. Despite those resilient and improving earnings, in fact, there were a lot of declines in terms of bellwether stock prices, which is leading to that reality of more attractive valuations at the start of the year. And will investors take advantage of that? Well, that will all depend on investor sentiment. Certainly for the longer term investor, there is a much more attractive value proposition on offer. However, there was generally weaker investor sentiment observed in 2023. And when we take a look at the trading direction of stocks as well as the trading activity on the Trinidad and Tobago Stock Exchange was certainly a lot lower than it was in 2022. At the international level, or turning to the international drivers, stronger earnings are expected to again remain broadly supportive of U.S. and international equity markets, as well as that cooling U.S. inflation, which is increasing the likelihood that U.S. interest rates have peaked. Of course, only time will tell as to what direction the U.S. Federal Reserve takes into, or the timing and magnitude of those interest rate decreases. But certainly the odds are that U.S. interest rates are not going to go any higher anytime soon. Of course, all of those things are supportive for more positive equity markets at the international level. However, keep an eye on those geopolitical tensions, which could certainly spook investors from time to time as we continue into 2024. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. Or you can check out our website, where all of our research is absolutely free, at bourseinvestment.com. And next week, we'll be taking a look at some of the forecasts for the local and international equity markets and where you might want to start putting some more of your money to work in the year ahead. Stay safe, happy investing, and we'll see you next time on the Bourse Report.